Hello everyone and welcome to today's video. In today's video, I'll try to explain why at this time I feel that one should stay away from bank stocks, and in my opinion, why do bank stocks have a hold rating, and one should not be taking or opening new positions in banking stocks. So before we proceed, a quick look at the disclaimer, which simply states that whatever information I'm sharing with you is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to trade or invest your money, please get in touch with a certified financial advisor and understand the risks in trading and investing. Quick call out that the trades that I'm taking are being made available free of cost on the community tab of my channel. So you can just go to my channel's community tab, and there you will see various trades are listed as and when I take them. All you have to do is subscribe to the channel and enable the notifications. So what will happen is that as soon as I post a trade, you will get notified. Then you can come and see the trade and follow the trade, and it forms a really good learning experience in my opinion. So hopefully you will find it useful. Now let's quickly get into the crux of the video, which is where I have been looking at the banking sector lately, and I have concluded that in my opinion, the banking stocks should be given a hold rating as of now, and one should not open new positions or take new positions in any of the banking stocks. And I have a couple of reasons which kind of logically explain my conclusion. I would request you to look at each of these reasons and let me know in the comments with which of the reasons or whether with all of the reasons if you agree. And if you don't agree with any of these reasons, I would love to hear the opposite side of the explanation as well. So please leave that in the comment section and it would form a good discussion. So the first reason why I feel that banking stocks are a hold rating right now in general is because of a possible decrease in the net interest margins. So for this, we need to understand how banks actually make money. Banks are actually taking deposits from the depositors in terms of the money which is put in our checking and savings accounts. And then this money is lent to people who need loans and other institutions that need loans. So the difference between the interest that is paid to the depositors and the interest that is charged from the people who are taking loans is the net income for the bank. Recently, if you see, Fed has been increasing the interest rates, but the banks have increased the interest rates only on one side. The interest rates being given for the deposits to the depositors have not gone up till now, and only the interest rates on the loans being issued by the banks have been going up. So if you look at the last couple of quarters, banks have actually made a lot of additional money because they have been getting higher returns on the loans that they are making, but none of those higher earnings are being given to the depositors. And right now there is a lot of pressure, and it's already been delayed. So there's a lot of pressure on the CEOs of the various banks to start increasing rates being offered to the depositors. And it's going to start with one bank, and soon as one bank increases the rates on the deposits, other banks will have to follow suit. And in my understanding, what I feel is that the current stock price of the banks factors in the fact the earnings that the banks have shown in the last couple of quarters. But these earnings can take a really good hit once the net interest margins fall, because sooner or later banks will have to start increasing the rates that they are going to offer to the depositors. And once that happens, this will clearly be visible in the bottom line of the banks. Their overall net earnings will go down, and the Wall Street will actually bring down the stock prices to reflect the reduction in the earnings. So that is the first reason that I feel that the bank stocks are going to see lesser earnings because of reduction in the net interest margins, which should bring down the stock prices. So for me right now, bank stocks are a hold, and we may get a much better entry point 2 3 months, maybe 6 months down the line, once we start seeing the banks increasing the interest rates being offered to the depositors. The second reason is that although Fed has done multiple rate hikes, the inflation is still not coming down. It's kind of peaked, I think. That's my opinion again. So it's not increasing at the rate that it was increasing earlier, but it's in no way coming down, and it's nowhere close to the Fed target of 2%. So the Fed is going to continue increasing the rates in the near future, and that in general is going to slow down the economy. And we are looking at a pretty high possibility of a mild recession. And as of now, I would say I feel that the recession would be mild in nature and not very bad, but things can go bad very quickly. So that is another factor, because the overall economy is going to slow down. Obviously, banks form a part of that economy, and when everything is slowing down, the net earnings of the banks again will take a hit because of that, because their overall business will be coming down, and that will again be reflected in a reduction in the stock prices. The third reason is that banks make their money from the loans that they issue to institutions and individuals who need that money. And as the interest rates are going up, a lot of institutions and a lot of individuals are going to defer these loans. That means whatever projects the institutions were planning to execute, or whatever purchases the individual borrowers were planning to make, they are going to delay those purchases, because obviously they have to pay a much higher interest if they take the loans right now. So imagine somebody was planning to buy a new car and take a car loan, or somebody was planning to buy a new house. We are already seeing that the housing market is slowing down. The car loans are also slowing down. The reason is very simple, because if you bought a car 2 years back, probably you were paying $400 or $500 of an installment, but now those installments have gone up significantly with the increase in the interest rates. So obviously, unless it's an emergency and you really need to change your car, or you really need to buy a house, most people are going to defer these purchases and wait for a more suitable time when the rates are offered at a lower level, or at a more reasonable level, or at least when there is more certainty in the economy that people are going to have not be losing jobs. If you see recently, the tech sector itself, if you just look at companies like Facebook, Twitter, Amazon, Microsoft, about more than 100,000 employees have been uh, let go. And it's not just the employees which are basically let go. You have to understand that these people who lose their jobs, they create a lot of momentum in the economy, because anybody who is earning a good salary, they go and purchase a lot of goods and services. So other businesses also thrive because somebody has a good salary, and they have the ability to spend, and that spending power is what drives other businesses. So when a huge chunk of people lose their jobs, and what that results is in a decreased spending, and other businesses which depend on the spending also slow down. So they are also going to start laying off people. So it becomes a chain reaction, and that's how the overall economy slows down, and that is how we actually end up in a recession. So, in my opinion, these are the three primary reasons which kind of make me feel that the bank stocks will be under pressure over the next 3 to 4 months, at least 6 months, until we have clarity about the interest rates, and until we have clarity about the kind of recession that we are going to end up in. If you look at my personal holdings on bank stocks, I just have a position, a very small position in Citibank. And the reason I have that position in Citibank is because it pays out a very good dividend. If you compare it to the rest of the banks like JP Morgan, Morgan Stanley, Citibank relatively has the highest dividend payout. So I have been holding on to this position, and I am holding it for the long term, unless I'm forced to sell it off based on the assignment on the covered calls that I sell. So for me, this position is a long-term position. It's a dividend-paying position, and I keep selling covered calls on this position to collect the premium. So that's the reason I have this position, but I'm not taking any other positions or new positions, especially in any of the other banking stocks. Today, I have initiated a position, a sell of a put and option trade on the Silicon Valley Bank, and that is a very different kind of trade because it's highly undervalued again, and I am not really looking to buy shares of this company. But if you look at the trade, you can follow the trade on the community tab. If you follow the trade, you will actually realize that my intent is to collect about $350 of premium without having to buy shares of this company. Or if I do end up buying shares of the bank, they are going to be at a very, very deep discount. So you can get the details of the trade on the community tab. And if you have any queries around them, please leave them in the comments. I will definitely answer you on what was my reasoning to take the trade. So I hope this video was useful, and you may agree with some of the reasons that I have given about the outlook that I have for the banks. If you agree with my reasoning, please let me know in the comments. If you do not agree with my reasoning, I would love to hear your side of the argument as well. So you can leave that down in the comments. As usual, please share this video with your family and friends, and I'll catch you guys in the next video. Thank you for your time.